Silver is dropping right now, and every short seller thinks the chart just gave them a green light. A bearish triangle breakdown is locked in on the daily chart with a measured target near $57.50. But Bank of America's commodity desk and JP Morgan's asset management arm are watching something completely different underneath that same chart. They are watching COMEX registered silver inventories that have collapsed by close to 70% since 2020. This is the contradiction almost nobody shorting silver today has actually sat with. The chart says sell. The vault says there may not be enough metal to deliver against the contracts already outstanding. When paper positioning and physical scarcity disagree this violently, the side that is wrong does not lose slowly. It gets liquidated all at once, usually on the exact day it felt safest to be short. If you are shorting silver right now, or even thinking about it, you need to understand why this particular setup has a history of punishing bears before you place that trade. As of Wednesday, July 8th, 2026, silver is trading at $62.08 an ounce, down from $62.81 just 2 sessions earlier. Gold sits at $4,052.94, following news of a U.S.-Iran interim peace agreement that has pulled some geopolitical risk premium out of the entire metals complex. The Federal Reserve, under new chair Kevin Warsh, held its target range at 3.5% to 3.75% through June, with the next decision landing July 29th, 2026. Last week's non-farm payrolls report showed just 57,000 jobs added in June against a forecast of 110,000. The CME FedWatch Tool cut the odds of a September rate cut from 66% down to 50% within 24 hours of that release. At the same time, FX Leaders is calling a bearish triangle breakdown with a lock target near $57.50, citing what they describe as post-treaty carry cost pressure. To understand why this breakdown might be a trap rather than a green light, we have to trace the mechanism from the start. Think of the silver market right now as a dam holding back a river that has been rising for 5 straight years. Since 2021, global silver demand has outpaced mine supply every single year according to the Silver Institute's own survey work. That deficit does not vanish because a chart draws a bearish triangle. It gets absorbed instead by drawing down physical metal sitting in vaults in New York and London. This only makes sense once you understand that COMEX and LBMA stockpiles are not bottomless reserves. They are the last buffer between a shortage on paper and a shortage in the real world. On January 1st, 2026, China implemented strict export licensing on refined silver, requiring exporters to hold at least 80 tons of annual production capacity just to qualify for a permit. Before we get to the consequence, we need to understand the cause, and the cause is that China refines close to 70% of the world's silver while consuming roughly 80% of what its own solar and electronics sectors require. When Beijing tightens that tap, the West cannot simply source silver elsewhere because no other country refines at that scale. That is the dependency step most short sellers are skipping entirely. The consequence is COMEX inventories down close to 70% from 2020 levels, with LBMA vaults in London down roughly 40% over the same stretch. So while the futures chart is drawing a pattern traders read as bearish, the physical layer underneath is telling a story of scarcity, not abundance. This is the exact setup that history has taught the market to fear. A paper market pricing silver as if supply is plentiful, while the physical market is quietly running out of metal to deliver against. Add to this the gold to silver ratio, sitting near 65-1 at today's spot prices, well above the historical extremes near 15-1 that show up when silver catches up to gold during monetary stress. Every short position taken against silver here is a bet that this deficit mechanism reverses instantly, and nothing in S&P Global's mine cost data suggests new supply is coming online fast enough to make that true. Here is what most of the coverage of this bearish pattern is missing completely. A technical breakdown in a futures contract measures paper positioning. It does not measure the amount of physical metal available for delivery. Wells Fargo Investment Institute noted in its recent commodity outlook that industrial demand from solar manufacturing, electric vehicles, and AI infrastructure buildouts keeps growing even as speculative futures positioning corrects. In other words, the same speculative flows scaring traders into shorting silver right now are the flows that could reverse violently the moment short covering begins, precisely because the shortage underneath has not gone anywhere. That is the part almost nobody discussing the $57 target is talking about. If you have made it this far, you already understand something most people watching a 5-minute chart breakdown clip do not. You understand that price action and physical reality can diverge for a while, but they eventually reconnect, often violently. That is the entire reason this channel exists, to help you see the mechanism underneath the headline before the headline catches up to it. If that kind of analysis is useful to you, subscribing means you're positioned for the next update the moment new institutional data shifts this picture, rather than finding out after the move has already happened. Now let's get back to what this actually means for you. Before we move into scenarios, ask yourself an honest question about your own position in silver right now. There is a version of you that holds silver, or is considering shorting it because you have actually worked through the deficit numbers, the China export data, and the COMEX inventory drain, and you have a clear thesis with a defined point at which you would admit you are wrong. Then there is a version of you simply reacting to a chart pattern or a headline, hoping the position works out because you cannot really afford for it not to. Those two versions of you will behave completely differently the next time silver moves $3 in a single session. One of you will check the thesis. The other will check the price every 4 minutes and feel their stomach drop. I'm not telling you which one you are. I'm asking you to notice which one shows up the next time volatility tests you, because your actual behavior under pressure tells you more about your real relationship with risk than anything you currently believe about yourself. From here, there are two paths, and the data between now and a specific date will tell us which one we are on. In the first scenario, the Federal Reserve's July 29, 2026 decision comes in hawkish. Kevin Warsh signals no cut this year, the dollar firms further, and the bearish triangle completes its measured move, dragging silver down through $57.50 toward the $50 handle. Several technical desks are already flagging as the next major support. In that world, short sellers who timed the breakdown correctly get paid, and the physical supply story becomes a slower background thesis rather than an immediate price driver. In the second scenario, the July 29th decision surprises dovish, or COMEX delivery notices spike again the way they did during the 2025 squeeze, forcing paper shorts to cover into a market with the tightest visible inventory in decades. In that world, silver clears $64 to $64.50, the level Bank of America has flagged as confirmation of continuation, and a push toward the $70 handle becomes the base case rather than the bull case. A third possibility is simple range consolidation, where silver chops between $60 and $64, while both sides wait on the next China export data and the next Silver Institute supply update to force a decision. We will not know which of these three paths we are on until the July 29th Federal Reserve decision, and the delivery data around it are actually in front of us. So here's the question I actually want you sitting with. Not whether silver hits $57 or $70, because a number alone tells you nothing about how you would have handled either outcome. The real question is this: if you end up proven right by an outcome you never actually understood, is that a good trade, or did you simply get lucky in a market you have not yet learned to read? Write your answer in the comments. I read them. And the conversation that question tends to generate is one of the more honest ones this channel has. This is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history of the market and the ownership questions so you can make your own decisions with your own money and your own risk.